Welcome. In this explainer, we are going to break down the latest RBI half-yearly report on foreign exchange management. Now, this is an absolutely crucial topic for your upcoming exams, so you'll want to pay close attention. Okay, let's dive into this. So here's our game plan. We're going to follow a clear path, starting with the fundamentals, then moving to the very latest data, the RBI's strategy, and finally, we'll wrap it all up with a consolidated summary, perfect for your revision. First things first. When we talk about India's massive Forex reserves, what are we actually talking about? Let's take a look under the hood of India's financial shield. You might be picturing a giant pile of US dollars, right? But it's actually not that simple. The RBI manages a really sophisticated portfolio, and it's built around four main components. And here they are. Now, for your exams, you've got to lock these in. So here's a quick mnemonic to help you out. For good scores, remember this pie. Pretty good, huh? What's really interesting here is how each of these components plays a completely different and vital role. So the FCA is the real workhorse of the reserves. It's the biggest piece of the pie by far. And it's not just one currency. We're talking US dollars, euros, pounds, yen. This diversification is a key risk management strategy for the RBI. Next up, you've got your IMF-related assets, SDRs, and the RTP. The easiest way to think about SDRs is as a claim on a basket of the world's most important currencies. The RTP, on the other hand, is kind of like an emergency fund that India can access from the IMF, no questions asked. Okay, so let's move on to the latest numbers and see how all this builds up. This is where you'll find those key data points that are just perfect for your prelims. And here it is, the headline figure you absolutely must remember. Just over 700 billion US dollars by the end of September 2025. That is a massive financial buffer for the country. And check this out. That represents a huge increase of nearly $32 billion in just half a year. So the big question is, where did this increase come from? This table breaks down the growth, and this is where it gets really interesting. The crucial point here is the huge jump in the value of our gold holdings. That contributed the most to this period's increase, over $19 billion. All right, now let's analyze the underlying reasons for this change. We're going to dive into the balance of payments data to see what's really going on. You know, it's super important to distinguish between new money coming into the country and the value of the assets we already hold simply going up. And for the period from April to June 2025, these valuation changes were, well, they were massive. And this chart just illustrates the point perfectly. That valuation gain of over $25 billion, which happened mostly because the US dollar weakened against other currencies, completely dwarfed the actual new money inflows from the capital account. So we have over $700 billion. The next logical question, especially for your mains exam, is that enough? Well, the RBI uses several key metrics to measure this. The first key metric is something called import cover. At 11.4 months, it shows a very comfortable position. It basically means we can cover nearly a whole year's worth of imports, even if our exports suddenly dropped. And here's another crucial ratio. This means our reserves cover our short-term debt obligations more than 5 times over. That is a really strong sign of our external sector's health. The RBI has also been strategically increasing its gold holdings, and you can see why. Gold acts as a safe haven asset, and notice that its share of the total reserves has been increasing. That's a deliberate move. So managing such a vast sum isn't simple. Let's look at the core principles and the risk management framework that the RBI follows, which, by the way, is all governed by the RBI Act of 1934. Okay, remember this hierarchy for your exams. It's safety and liquidity first, always. Preserving the capital and ensuring the money is readily available comes before trying to chase higher returns. So the RBI's risk management is built on these 4 pillars. They have a robust defense system to guard against all kinds of financial threats, from someone defaulting on a payment to internal system failures. Now, within market risk, these are the 2 big ones. RBI manages currency risk by, you guessed it, not putting all its eggs in one currency basket. And it manages interest rate risk by controlling the portfolio's sensitivity to rate changes. All right, let's bring it all home now and consolidate everything you're going to need for your exam revision. Pay close attention to this final slide. Seriously, this is designed to be your quick reference guide, your cheat sheet. And there you have it, the absolute core of the RBI report. So the crucial point here is understanding not just the numbers, but the story they tell about the strength and resilience of India's external sector. And that leaves us with a key question to think about. How will this robust reserve position influence India's future monetary policy and its global standing?